I would not expect it to smash through the 48 to $50 all-time highs um, in the first try. That's generally not how it works. And so I wouldn't think we would get there this year. You go up, we could go to, I think the next move is in this current move is probably to 43 and a half, 44, given the channel that we've been tracking higher. Pull back, maybe under certain conditions, we make another run later this year. I think it's in next year. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through. You go up, tap it, find resistance.
Amid rising debt, weakening currencies, and mounting supply risks, gold and silver are emerging as pivotal markers of financial stress and strategic necessity. Craig Hemke, a well-known precious metals analyst, highlighted that silver's current position around $42 is especially significant, describing it as rarefied air and emphasizing the importance of its ability to sustain this level. Reflecting on April 2011, he noted that silver's rapid surge from $38 to $48 was not the result of a speculative bubble as often portrayed, but rather a commercial short squeeze revealed in the commitment of traders' reports. Looking ahead, Hemke does not expect silver to break through its all-time high of $50 on the first attempt, but he does foresee potential moves into the mid-$40s this year, with a larger breakout possible next year if conditions such as rate cuts and yield curve control materialize. He explained that a sustained move above $50, turning old resistance into support, could unleash a much stronger rally, especially given concerns about real supply, leverage in derivatives, and the availability of physical silver. Hemke also pointed out that while nearly 10,000 September silver contracts, about 50 million ounces, stood for delivery, the figure is not unprecedented compared to past months with 15,000 to 18,000 contracts. Additionally, he drew attention to recent reports that Saudi Arabia's sovereign wealth fund purchased around $1 billion worth of SLV shares, an event that could have implications for both market sentiment and physical supply. Before we dive deeper into their insights on gold, silver, and the broader financial system, make sure to like this video, subscribe to the channel, and tap the bell icon so you never miss the latest updates.
I think more interesting regarding silver is just it's just the fact that it's $42. I mean, that's pretty rarefied air, and sustaining at this level, at least for now. That's probably the most significant development. Well, I'm not in that crazy breakout camp just yet. I think it's an important time for people to be paying attention to what's going on internally with silver. In April of 2011, okay, so most people remember that, price went from 38 to 48 in about 4 weeks of that month, over the course of the month. And it was assumed, it was written up, and people look back, with revisionist history and make it sound like it was a big speculative bubble. What was actually going on, if you followed the commitment of traders report back then, was a commercial short squeeze. They had all these speculators that are long, all these commercials that are short, and they started having to cover shorts for, without going into all the details as to who was short and why and all that stuff. But you could just see it on the commitment of traders reports. And that's what took it from 38 to 48. I think, could we have a similar month now? Of course. But we want to be watching those commitment of traders reports, because it'll tell you a lot. If the commercial side of that equation is aggressively adding new shorts this month, okay, well, we're just in that kind of stair step phase, of 2 steps forward and 1 step back. But if we start seeing a lot of commercial short covering without a lot of new speculative money yet, and that's what drives us, well, then, when we get that breakout of, top of the cup, then you get this big rush of speculative money that just catapults you further. Because silver's a lot like, and I'm sure I've used this metaphor before, it's like Newton's law of inertia or motion or whatever it is. I took physics, but it was a long time ago. An object at rest remains at rest until a force is applied to it, right? Just sit there. My computer right here, but if I push it, okay, all right, it'll remain at rest until a force. And that's kind of what silver's like. Silver just sit there, as we all know, and just do jack for a long period of time, even like not keeping up with gold because people are waiting. They're like, well, I'm not going to get involved in silver yet because it's just sitting there doing nothing. But then as it starts to get moving, then you get this kind of FOMO thing. Hey, we've seen this before. And so what will probably happen, I would not expect it to smash through the 48 to $50 all-time highs um, in the first try. That's generally not how it works. And so I wouldn't think we would get there this year. You go up, we could go to, I think the next move is in this current move is probably to 43 and a half, 44, given the channel that we've been tracking higher. Pull back, maybe under certain conditions, we make another run later this year. I think it's in next year. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through. You go up, tap it, find resistance, finally break through. Everybody goes crazy, and then it pulls back, tests that old resistance level for support. And if it finds the support and you stay above 50, and then start making new highs after that, well, then, holy Toledo, then we could have some fun. And this all the stuff we've talked about all these years, Elijah, about how much silver is there really in the world? The supply deficit over the last 4 years. How much free float is there in London? How many ounces are levered? How many times supporting the derivative markets? All that stuff. If we set off on this, break through 50 and everybody starts getting excited and the banks don't want to fool around with it anymore because they don't have it, they don't want to deliver theirs out or whatever, things could really get spicy next year. Well, I saw that stuff too last week. There were 9,000, I can't remember, 9,900 or something COMEX September silver contracts that were open and standing for delivery when that contract went off the board. And then it gets delivered against, you got to be 100% margin long covered so that you can take delivery if that you're long and somebody the short puts the silver to you. And historically that's a lot. But back in March and May, we were doing 15, 18,000 contracts. Okay, so it's not like, oh, wow, it's 10,000 in September, the system. No, it's not. No, not yet, at least. Okay, but it is a not insignificant amount. If we've already delivered almost all of those, that's 50 million ounces. I don't know if it ever actually leaves the COMEX or if it's still just this, oh, this month I'll take delivery, next month you take delivery stuff. So we'll keep an eye on that. I don't think that's where the stress is. I don't, to me, after kind of getting excited about that 15 years ago, I don't think that it's the COMEX where you'll see delivery stress. It's more likely in London. I'll give you this. I mean, you've seen over the years, Elijah, and I'm sure everybody listening has seen this. We're like Stan Druckenmiller or Ray Dalio or whomever, some big hedge fund manager. They'll say, we want to own gold. And you're like, good. And then they buy the GLD, right? And you're like, well, what good is that? I mean, that gives you price exposure, but you don't really, you can't take delivery Stan. You can't take delivery Ray. Okay, well, there was this news last week. It looked like the Saudi whatever sovereign wealth fund had bought $1 billion worth of the SLV. Did you see that? Well, I thought that was interesting. Now, maybe they're just playing the same, we just want price exposure and liquidity game like Druckenmiller. Maybe they wanted the silver and maybe they were told you know, we don't have that much to deliver. If you ask for it, here in the city of London, we can't ship that to you on a timely basis. Would you please just buy this instead? So, it'll be like I said, I don't think. I mean, everybody gets all excited about the COMEX and will the COMEX fail? I think your delivery stress is going to be found. If the house of cards start to collapse, it's going to emanate from London or it's going to emanate from one of these unallocated pool accounts things that some places run. That could set off almost like a little mini bank run. I'd say that's more important.
Craig Hemke emphasized that gold's current trajectory is unusual when viewed through a historical lens. Typically, after a year in which gold gains 25% or more, the following year brings only modest increases or even retracements. This time, however, by September gold had already added another 30%, which he sees as a significant warning sign. He underscored that the rise is not because gold itself has become more valuable, but because the dollar is losing purchasing power. A decade ago, an ounce of gold cost around $1,100 to $1,500. 5 years ago it was $2,200, and now it requires $3,500. What has changed is not the metal, but the number of dollars needed to acquire it. Hemke also pointed to a repeating pattern over the past 2 years. Gold surges 15 to 20% after a breakout, consolidates for several months, and then rallies again. After holding under $3,500 earlier this year, gold has now broken higher, and if the cycle continues, it could climb toward $4,000 an ounce. Adding to this momentum is the potential policy backdrop. Hemke argued that central banks, particularly in the U.S., may soon be forced into yield curve control to contain soaring debt costs. This strategy, which mirrors the post-World War II era when the Fed and Treasury worked together to suppress yields and gradually inflate away debt, would likely push real interest rates further into negative territory. Let's get back to the interview.
25% year in gold last year, which was the third time, maybe fourth time this century that's happened. Every year that has followed a 25% year has been, I think the best we've done is 10. Sometimes just give a part of it right back. So the fact that at least here we are in September and we've already tacked on another 30% should be an alarm bell for everybody. And the proper way to look at this is not that gold is becoming more expensive. It is the dollar which is losing its purchasing power versus gold. Uh, we talked 10 years ago, Elijah, it took 1,500 Federal Reserve notes, or 1,200 back at the bottom, 1,100 Federal Reserve notes to buy an ounce of gold. And then 5 years ago, it was 2,200. And now it's 3,500. It's the gold's not changing. It's how many dollars it takes to acquire it that's changing. Lastly, what you're seeing even today is the price has been steadily moving upward over the last 2 years. And it surges it breaks out, it surges 15%, it consolidates for another 3-4 months, breaks out, surges 15, 20%, consolidates for 3 or 4 months. This has happened 3 or 4 times now. And as most people know, it's been consolidated under 3,500 since about April or May. It's now broken out, and I think there's a rush of speculative interest because another 15%, if we keep the pattern going, takes us up to about $4,000 an ounce. That's the deception of the dollar index because it just compares the US dollar versus all this other equally worthless fiat, right? And so the dollar over time, you pull up a 30-year price chart of the dollar index and it's 100 and it goes up to 120 and down to 80 and it just stays basically the same. Well, that's because all the other fiat currencies are devaluing at the same rate. Whether it's globally, if all these central banks have to do that to control the long end of their curve, right, and control their interest costs. But I think you're definitely being told and warned that it's coming here in the US. And I think that's all part of what's driving gold too, because that would be extremely bullish news for gold. You'd be holding real interest rates sharply negative. I mean, the US has done this before, which is why I wrote about it in my pod. I even put a link in there in that macrocast because coming out of World War II, when we had similar debt to GDP ratios, that's what they did. They kind of combined the Fed and the Treasury together. They did yield curve control, essentially to pay off the debts of yesterday with the cheaper money of tomorrow, right? Get it under control, grow your way out of it, which is what Besant keeps talking about now. Well, anyway, if you want to take the time, to connect the dots, I mean, I think they're telling you that's what's coming as soon as next year, once Powell gets replaced and everything else. And so if that's the case, they're going to be trying to cap the long end. It's going to involve a lot of new quantitative easing measures, central banks buying their own debt, monetizing, almost like a modern monetary theory move. Again, all of this is extraordinarily bullish for the precious metals in terms of devaluing the existing fiat currency. If the Fed comes out and says, we can't have the long end running away from us, all this kind of stuff. So the Treasury will be a buyer of, all long bonds above 4%. or all 10-year notes above 3%. Well, then heck, if you're, a hedge fund or pension fund or an insurance company or something, and you're worried about duration risk and you know the Fed's got your back, well, then all of a sudden buyers emerge for that paper. And the Fed didn't have to do anything. So that's the type of yield curve that control is probably coming, and then it'll probably have to be active after that. Either way, it's again, if I'm right about this, you ain't seen nothing yet for a number of reasons. You could say, well, it might increase the supply, right? Eventually, if the U.S. government is going to be subsidizing mining operations, but I don't know. I mean, it's interesting it's on the list. There were 10 or 11 that were listed as extreme risks. And it's a whole bunch of, eums and unums that you've never heard of before. Maybe the only one anybody's ever heard of is tungsten. I didn't, the U.S. doesn't produce a single ounce of tungsten. None. Like China produces 90%. U.S. doesn't produce any. And that's a critical. I use that as an example of where they listed critical. They listed silver and platinum and a whole bunch of others as an elevated risk. So it's noteworthy. I'm not sure if it has had an impact over the last few days, other than, getting people to go, oh, well, that's interesting.
Gold and silver are increasingly proving themselves to be more than just commodities. They are essential anchors in a world where debt, currency devaluation, and supply chain risks continue to intensify. Their movements are driven less by price speculation and more by the weakening purchasing power of fiat money, the structural imbalances in global trade, and the growing challenges of resource availability. The recognition of silver as a material of elevated risk only underscores how deeply these metals are tied to both industrial necessity and financial security. Gold, meanwhile, continues to push higher as negative real rates and monetary interventions erode confidence in paper assets. Together, gold and silver embody resilience against the growing fragility of traditional systems, reaffirming their enduring importance in shaping the path ahead. What impact could rise debt levels, currency devaluation, and resource risks have on the long-term value of gold and silver? Stay tuned. If you're interested in real, data-backed insights on the financial system, hit like and subscribe so you never miss the weekly updates. And if you follow Bitcoin-related news, consider subscribing to our other channel for more updates. Thank you for your support, and we hope you enjoy the video.